Hi, this is Jim Trippon, editor of Dividend Genius, with the high yield market commentary for April 22, 2009. Today's question is, are dividends going to continue to crash and burn? For those of you who depend on dividends to fund or supplement your cash flow, these are scary times. According to a recent report by Standard & Poor's, a record number of companies have cut their dividends during the first quarter of 2009. The total amount of money lost to American stockholders for these dividend cuts was over $77 billion. Now, at the same time, very few companies are announcing plans to increase their dividends. Should you be worried? You bet. That's exactly why Dividend Genius does research, so that you won't get caught in the death spiral that happens when a company cuts its dividends. When that happens, some investors usually cut and run, leaving those who are left behind holding a stock with a severely depressed price. The question is, how is Dividend Genius doing at keeping our readers safe? Our record for the last 12 months shows that not only have we kept our readers out of stocks that have cut their dividends, but in most cases, our companies have actually raised their payouts in spite of the global economic crisis. So far in 2009, out of 11 positions in our model portfolio, 5 companies have actually raised their quarterly distributions by 4 cents or more, 3 by 3 cents, 2 by 2 cents, and 2 have maintained them at the same level. Not a single one of our stocks has cut its dividend. Now let me put that in perspective for you to show you how difficult stock picking for high yield stocks is in this environment. This is the first time since S&P started tracking dividends in 1955 that dividend decreases have outpaced dividend increases. Now, we're not out of the woods yet. In fact, according to a senior analyst at Standard & Poor's, although the bulk of dividend cuts may have been completed, there's probably going to be a second round of dividend cuts as companies review their 2010 budgets and expenses beginning this fall. Now, finding the best dividend payers is harder now than it's been in decades. At Dividend Genius, we always look beyond the basic of dividend yield and payout ratios and get into scrutinizing the figures on a company's balance sheet, with a special attention to its debt structure. After all, we're in a credit crunch, and even profitable blue-chip companies like GE may have to cut their dividends in order to preserve capital or as they face maturing debt that they can't pay off or roll over. Now, although we had this huge market sell-off last year, some stocks have higher dividend yields now than bonds, and this is the first time that's happened in over half a century. For subscribers to our Dividend Genius letter, this means that you have the information to invest in the right mix of strong and well-capitalized dividend payers, and that can give you an income much higher than bonds. And what's more, our high dividend yield in stocks have, in the long run, a potential for growth that only equities can provide. This is truly a unique opportunity, and we don't know how long this window of opportunity is going to remain open. Take full advantage now of our solid dividend-paying stock research. We have a rare opportunity to harvest high yields while stock markets are relatively low and reap even a greater gain when a full market recovery occurs. I'm Jim Trippon, editor of Dividend Genius, your smart research on high yield stocks. Visit dividendgenius.com today and get your free trial of our award-winning research on high yield dividend-paying stocks.